first thing is we got to put a few definitions out here. First one is, let's define what an account is. Okay, so an account in essence is going to be like the columns that we had on those spreadsheets that we were just working on the previous segment. So in other words, an account could be cash, or it could be accounts receivable, or it could be accounts payable, or it could be a revenue account or an expense account. In other words, every single classification or category that we would be putting money into or taking money out of would be an account. We can set up an account so that it looks like this. We can make a T, and then we would put the account name up here on top. And when we do that, what we've done is we've created what's called a T account. And T accounts, all T accounts are going to have a very similar structure in that the left side of the account is what's called a debit. Pretend like you've never heard the word debit before in your life, and wipe it from your memory banks, and from this point forward, the word debit means left side. Okay? Nothing else. Debit means left side. And then on this account, we have the right side, and I want you to, again, disassociate whatever you think you know what a credit is, wipe your memory banks clean, and from now on, when we use the word credit, we're talking about the right side of an account. There's some abbreviations that will probably be helpful for you. Credit is abbreviated as CR. Okay, so CR is the abbreviation for credit, and debit doesn't make any sense, but it's DR. Okay, so debit is abbreviated with DR. So if you see me write down DR cash, that means we're debiting cash. Okay, debiting the account of cash. There's a few other terms that we need to throw into the mix. There is something called a ledger. Okay, all a ledger is an accumulation of all of these T accounts. Okay, so a ledger is all T accounts. Okay, these T accounts would be listed out just sort of all next to each other, and when you group all of them together, that's the ledger. Okay, so let's expand a little bit on this idea of what an account is, and the debits are on the left and the credits are on the right. What I want to do is put together a big T account, and we're going to put across here assets equal liabilities plus equity. Okay, so there's our accounting equation, and what we're saying is that on this T account, the left side of the T is our assets, and the right side is our liabilities and equity. So let's write down a couple of asset accounts. We know a few of them already. Cash would be an asset account. Accounts receivable is an asset account. Prepaid accounts, inventory, supplies, equipment, all of those are different asset accounts that we've talked about. Okay, I'm just going to write a couple of them just because I only have a little bit of space here. Asset accounts, just like we learned a few minutes ago, debits are on the left and credits are on the right. Okay, and when we talk about an asset account, to increase an asset account, we debit it. Okay, so I'm going to put up arrows on the debit side for any asset account. Now I just have these two listed, but it would be true of any asset account that we could ever think of. Debit will increase it. And if a debit increases an asset account, then it would stand to reason that a credit would decrease it. Okay, so assets go up with debits, down with credits, or we could also say it goes up with the left side, down with the right side. Okay, so that's the rule of assets when it comes to the debits and credits. So the way I like to describe that is that the behavior of an asset account is that it increases with the debit decreases with a credit. Okay, let's move over to liabilities. So liabilities, we've learned that accounts payable is a liability. We've learned notes payable, unearned revenue. Those are some of the liability accounts we've talked about. They all have the same behavior. So I'm just going to write accounts payable, but this would be true of any liability account. Debit is still on the left, credit is still on the right. That doesn't change. But now what happens is that the behavior is different than an asset. Liabilities behavior is that credits increase liabilities and debits decrease liabilities. So you can take any liability account, no matter what it is, and if we're crediting it, we're increasing it. If we're debiting it, we're decreasing it. Okay, so we could say that the behavior of a liability account is that it increases with a credit and it decreases with a debit. Okay, so let's move over to equity now. So we know that there's two forms of equity. One form is stock. And then the other form, I'm going to make this a big one here because we'll see why in a few minutes. The other form is retained earnings. Okay? Same story, debit is on the left, credit is on the right. With stock accounts, a stock account would increase with a credit. Okay, so they have the same behavior as liability accounts. And then another thing with these stock accounts is, until you get into more advanced accounting than what we're going to cover, there's no reason that we would ever decrease a stock account. In other words, once you issue stock, you can't unissue it. Or if you do, it's a very complicated transaction that we're never going to see in an introductory course. So what we can do is kind of flag that debit side as kind of a red zone, right? In other words, there's no reason that we would ever want to debit a stock account. So I'm going to scratch that out, and if you ever find yourself trying to debit a stock account, then you know something is going wrong. Okay, retained earnings, same story. Debit is on the left, credit is on the right, and it has the same behavior as stock because it's an equity account also. And there will be times when we want to increase it and times when we want to decrease it, so we can't cross anything out there. Okay. Think about retained earnings, right? It goes up with net income, and net income is increased because of revenues, and it's decreased because of expenses. So what I'm going to do is over here on the credit side, I'm going to create an account, and I'm going to call it revenue. So that's generically referring to any type of revenue account, sales, fees earned, any type of revenue account we might have. Okay, and same story, debit is on the left, credit is on the right, and revenue accounts go up with a credit. In other words, you could almost think of it like this. You could almost think of it as this increase here to this revenue account has the impact of increasing our retained earnings. Okay, which makes sense because revenues increase net income increases retained earnings. And revenues, we've learned that once we record revenue, we can't unrecord revenue. In other words, let's say that our revenue is a fees earned. Say that we earn money by washing somebody's car. Once we wash their car, we can't unwash their car. Now granted, we could go get it dirty again, but that doesn't undo the fact that we washed it. So once we earn some revenue, we can't unearn it. So therefore, there's never a reason, well, there'll be a reason later, but it'll be a special reason. For right now, there's no reason we would ever decrease the revenue account. So what I've done is I've made the debit side of revenue kind of that red zone, because if we ever find ourselves trying to debit revenue, we know that something's going wrong. Okay, now let's move over to the debit side of retained earnings. And the first thing I want to put here is expense. Okay, so this refers to any and all expense accounts we might ever have. So rent expense, insurance expense, supply expense, etc., etc., etc. Okay, same thing. Debits are on the left and credits are on the right. Okay, and To increase an expense account, the behavior of an expense account is that it increases with a debit. Okay, we could think of that kind of like this. An increase to expense reduces our net income, which has the impact of reducing our retained earnings. Okay, so an increase to expense reduces net income. Net income, if it's smaller, is going to make retained earnings smaller. Okay. Further, we will never, except for one exception that we'll learn about in quite a while from now, want to credit an expense account. So in other words, once we have our employees work for us and have some wage expense, we can't undo them working for us. Okay? So therefore, if we ever find ourselves trying to credit an expense account, then we know something is going wrong. Okay? One more account that we need to get in here. I've kind of run out of room, but I'm going to squeeze it in. What's the other thing that reduces retained earnings? Well, dividends reduce retained earnings. So what we want to do is show the dividends account also over here on the debit side of retained earnings. So I've kind of run out of room, but I'm going to squeeze it in right here. This is dividends. Okay, debit on the left, credit on the right, and it's going to have the exact same behavior as an expense because it reduces our retained earnings. Okay, so what we have here is now this framework that allows us to think about any type of an account, and if we know what type of an account it is, in other words, asset, liability, equity, revenue, or expense, or dividend, then we know what its behavior is, even if it's an account we're not familiar with. But if we know what type of an account it is, now we know its behavior. And when we talk about behavior, we mean what effect does a debit have, what effect does a credit have. There's even a little bit of a pattern here. I'm going to switch to even a different color here so that we can kind of see this. You can see that this group of accounts here all have the same behavior, right? In other words, the asset accounts, the dividends, and the expenses. And these accounts here all have a similar set of behaviors. In other words, a credit increases and a debit decreases. So by using this framework, whenever you sit down to do some work, while you're learning this, I would take this model right here, this big T account, and write it down. And if you write it down before you start doing any work, then you can always refer to it, and it's going to be something that's going to really be helpful for you to make sure that you're increasing or decreasing your accounts appropriately. There's one other thing that, one other term that we need to get in here while we have this in front of us. And that term is what's called the natural or normal side of an account. Okay, I don't have a whole lot of room here, but what we'll do is write it right here. The natural or normal side of an account is the side of the account that makes it increase, okay, the side that increases the account. So in other words, the natural or normal balance of cash would be the debit side, okay, because that's what increases it. Or the natural or normal balance of accounts receivable, also the debit side, because that's what increases it. Come over to liabilities, the natural or normal balance for accounts payable would be the credit, because that's what increases it. In other words, think of it like this. Would it be natural or normal to have negative cash? Now, of course, you could have an overdraft, and that would be negative cash, but that wouldn't be a good thing to have, okay? Or is it possible to owe somebody negative amount of money? Okay, so on the accounts payable side, is it possible to owe somebody a negative amount of money? Well, no, because that would be them owing you money, okay? So the normal or natural balance is always what increases the account, okay? So you can kind of see I've got most of them circled there.